Welcome to another video of OptaTube. Today we're exploring a highly provocative, entirely hypothetical, but honestly deeply impactful scenario, one that would fundamentally rewrite the geopolitics of global energy. We're going to map out exactly what would happen to energy markets, power systems, and the global economy if the United States were to take operational or military control of Iran's Kharg Island, along with its critical oil infrastructure. Now, we're looking at this strictly through an objective, analytical lens to really understand the vast market mechanics at play. An action like this, it would be almost unprecedented in modern energy history. And as you'll see, the ripple effects would touch literally every single power grid and commodity market on the planet. To understand why this specific island matters so much, you really only need to look at this one number, 90%. Kharg Island isn't just some random piece of land. It is the absolute economic jugular of Iran. Roughly 90% of their crude oil exports are processed and shipped through this single strategic choke point. If they lose operational control of this island, Iran is transformed overnight from a major global oil exporter into a severely limited energy player. The sheer scale of this bottleneck is exactly why it sits at the very center of our hypothetical scenario today. Okay, let's dive into this and look at the immediate blast radius. What actually happens within the first 0 to 6 months? Well, the domestic shock to Iran would be catastrophic. With Kharg offline, their oil exports effectively halt. This triggers an immediate severe drop in foreign currency revenue, which leads straight into a national budget crisis and puts intense downward pressure on the Iranian rial. But taking an energy systems perspective, this is absolutely crucial. The domestic power grid would suffer immensely. With halted investments and massive fuel shortages, widespread blackouts become highly probable. The internal system would literally be starving for energy. But of course, in the global energy market, no crisis is isolated, right? 20%. That is the amount of the world's total oil supply that passes right by Iran's doorstep through the Strait of Hormuz. If Iran feels its entire economic survival is threatened by the loss of Kharg Island, this 20% becomes their absolute most obvious leverage point. The cost of insurance for oil tankers would skyrocket overnight, a tax on shipping could surge, and a massive chunk of global energy trade would just be instantly paralyzed. And this brings us to phase 2. This is where the conflict expands from a localized blockade into a full-scale regional energy war. Facing an existential economic threat, Iran's likely response would be asymmetric energy warfare. And the targets wouldn't just be ships out on the water. We're looking at potential strikes on Saudi Arabian pipelines, major disruptions to Qatari liquefied natural gas terminals, the targeting of UAE oil facilities, and even direct sabotage of regional power transmission grids. The entire Middle Eastern energy apparatus basically becomes a theater of asymmetric conflict. So what does this all mean? How does the market actually price in a full-scale Middle Eastern energy war? The short answer is severe macroeconomic shock. Under this scenario, global crude oil prices could easily surge into the $120 to $200 per barrel range. And, this isn't just a headache for traders on Wall Street. This is a staggering macroeconomic event for everyone. At $200 a barrel, global inflation reignites, transportation costs multiply out of control, and the fundamental baseline cost of industrial production worldwide shifts drastically, literally overnight. This builds a really complex picture for the neighboring Gulf states. It's definitely not a simple equation of higher oil prices equal pure profit. Take Saudi Arabia. Yes, they'd see a massive jump in oil revenue and increased influence in OPEC, but their strategic downside? Surging defense and security costs just to protect their newly vulnerable pipelines. The UAE could accelerate its growth as a safe haven regional logistics hub, but they take on heavily heightened infrastructure risk. And Qatar? They stand to gain massive spikes in LNG revenue, particularly from Europe, but only if their export routes remain unblocked. It's an incredible balancing act. Massive financial windfalls weighed against severe, brand-new security vulnerabilities. Zooming out a bit globally, we find the biggest geopolitical casualties of this scenario in Asia. China, being one of the largest buyers of Iranian oil, would take a massive hit. The immediate impact is soaring energy import costs, and long-term, this inevitably leads to reduced economic growth and forces an even heavier, potentially very uncomfortable reliance on Russian energy. India faces a similarly grim picture. The severe inflationary pressure from $200 oil would threaten to completely stall their rapid industrial expansion. For these major importers, this scenario is just an absolute growth killer. And then we have Europe, facing what is honestly a massive paradox. On one hand, you have the short-term pain, a severe energy crisis, soaring prices, and sheer supply chain panic as global LNG markets are completely shocked. But then, look at the long-term gain. Because of that short-term pain, this crisis acts as the ultimate catalyst. It would force a massive, totally unprecedented acceleration of their green transition, permanently breaking their dependence on fossil fuels way faster than any current policy dictates. It's short-term panic for long-term independence. Taking a quick pause right here. If you are interested in energy market and power system modeling and updates and insights about global energy market, let's follow OptaTube YouTube channel. We are constantly breaking down complex, high-stakes scenarios exactly like this one to help you stay ahead of the curve. Now, what's really interesting about this slide is the precise math hitting the European power market. The heightened Middle East risk means an immediate, vertical spike in global LNG and European TTF prices. That's the main benchmark for European gas. And because gas usually sets the marginal price in many grids, electricity markets are going to see significantly higher German power prices and wildly widened gas spark spreads. The profit margins for gas-fired power plants become highly volatile. But look at the infrastructure side. All this volatility and risk in fossil fuels leads to surging valuations for battery storage investments. Energy storage suddenly becomes the absolute most valuable asset class on the grid. Which leads us to the grand irony of this entire hypothetical siege. A massive, devastating military conflict over fossil fuels ultimately triggers a global renaissance in clean energy. By the 2035 horizon, the global clean energy accelerant is in full swing. Solar energy's economic appeal just skyrockets when it's competing against $150 or $200 oil. Wind power, especially the massive offshore projects, sees an incredible influx of protective capital. And perhaps most notably, nuclear power gets a rapid, heavily funded revival in countries that are suddenly deeply concerned about energy security, specifically places like France, South Korea, and China. Let's bring this narrative full circle, right back to Iran. If Iran loses control of Kharg Island for an extended period, it basically forces a structural shift in their entire national model by 2035. Oil takes a severely reduced role in their economy, and whatever gas they have becomes strictly focused on just keeping the domestic lights on. To survive, the nation is inadvertently forced to pivot. We project a massive expansion of domestic solar energy infrastructure, rapid growth in battery and hydrogen tech just to manage the grid, and a shift toward localized electricity trading. Out of pure necessity, Iran might actually transform from an oil-centric economy into an electricity-centric, low-carbon economy. Which brings us to our final thought for today. An event like the Kharg Island scenario wouldn't just be a localized military operation. It would be a structural earthquake on par with the 1973 oil shock, completely reshaping the geopolitics of energy forever. It leaves us with this massive, lingering question. Will the next geopolitical crisis permanently end the fossil fuel era? It is a fascinating, incredibly complex modeling challenge to ponder. Thanks for joining me on this deep dive into the data and the dynamics. Keep questioning, keep modeling, and I'll see you in the next explainer.